Hi everyone, welcome to Eagle Academy. My name is Tom, a trader with Eagle Investors, and today we're going to go over stocks versus ETFs. So to start off with, let's differentiate equities, ETFs, and then obviously another similar product, mutual funds. So equities or stocks is really just an individual stock in a company, typically is a high-risk investment with potentially wide price swings, the possibility therefore of larger losses if things go badly for the company. But on the other hand, a stock may also provide bigger gains if you pick the right company. The key here is that there is a concentrated risk and therefore higher exposure to the downside. ETFs can help kind of fix this, mainly because they invest in dozens or even hundreds of companies. Most have significant built-in diversification as a result of being this basket of securities offering exposure into these different segments. But it also trades on an exchange, meaning you can track an entire segment of the market while still being very liquid. It still, though, carries some market risk, can have some more fees, e.g. kind of expense ratio, as well as lower dividend yields, but it still does have dividend yields. And then finally, we kind of have this mutual fund, which is usually an actively managed portfolio from a pool of investors that will have stocks, bonds, and other securities. So it's a much more diversified and exposed pool. Investing into it, though, is considered very much of a passive strategy, letting it be kind of managed actively by these mutual fund managers. Now, ETFs, though, are going to be kind of the best when it comes to diversification and also the possibility for higher returns. Mutual funds will typically be on the lower end of the potential returns from these three investments, equities being obviously at the top, but being higher risks. So really, when it comes to favorable risk reward, ETFs could be the way to go, depending on your investment strategies and time frame, but we'll get into that in a second. So then why, in general, would you invest in an ETF aside from just the diversification or diversifying kind of your portfolio? Well, firstly, it's clearly a large and growing industry with over $4 trillion of assets under management right now in ETFs. We also have the idea that stocks in a particular sector are obviously going to be subject to dispersed returns. And investors may be unable to select those securities which are likely to continue outperforming, especially if it's not your day-to-day job and you're not a professional portfolio manager. So therefore, it's difficult to find a way to lower your risk on your own personal portfolio and enhance potential returns by picking one or more stocks in a sector that are going to outperform. Especially if there's sector-wide performance and momentum, it sometimes could just be better to invest in an ETF within that sector than trying to find an individual company. Some of this can be driven essentially or made more difficult by these idiosyncratic risks, idiosyncratic being kind of single risks to just one company or stock. So looking at Boeing, for example, even Delta or United Airlines or Lockheed Martin was doing well back before COVID, yet Boeing was already plagued with a bunch of idiosyncratic news, which was pushing the stock down, such as a lot of the crashes that we saw pre-COVID. So they were being hurt even before the sector-wide was being hurt by COVID. And so, you know, you can have these scenarios, you can have performance that depends on the successful development, sale of a new unproven technology. Really, in general, the dispersion of those returns in individual stocks in a sector can be very wide, and therefore the odds of finding a winner can actually be quite low. And so, though ETFs follow kind of the sector and end up being more of an average of that sector and market returns, where many do have the goal of also beating it, it is actually difficult or more difficult to choose companies successfully, individual companies successfully over a period of time, than investing in ETFs in a portfolio that ultimately end up beating the market, actually, and we'll talk about that in a second. So if you can choose sectors, momentums more successfully, which is a lot easier to do than single companies, you can actually outperform the market and at the same time have far less downside in your portfolio. So let's put this theory to the test. This is being kind of modeled out and we can see what wins over time, essentially. And so on the onset, again, mathematically speaking, every time you add more stocks to your portfolio, it becomes closer to average, and most of us want to do better than the average, which in ETFs can actually not be a bad thing. And if we look back at actually the history of an ETF and why you would choose an ETF in general, you can see that it essentially started from the index boom in the 90s, and then in the early 2000s, you started seeing people that wanted to invest in, or investors that wanted to invest in emerging markets and were finding it difficult to through different exchanges. There was less liquidity, and so you had iShares and Vanguard's building a lot of these emerging market ETFs, China, for example, being a notable one. And another one was equally weighted. So you can modify and change the weight. So that's also how you can kind of beat the market there. So that all gives a bit of a background to what this theory essentially tries to model out. Portfolio 1 is composed of 10 individual stocks on the basis that they must pay aggregate a higher dividend yield than the larger index. It's essentially trying to provide a goal of above achievers in both capital appreciation and current dividend yield. Each company had to have earnings per share growth in excess of the S&P 500 index. Each stock had to have a current dividend yield higher than 2.2%, a PE ratio of no more than 21. Again, trying to find a bit of that value there, market cap greater than 5 billion. And then all these initial investments were equally weighted. So what you ended up having is companies like Johnson & Johnson, Chevron, McDonald's, NextEra Energy, and all in 10 different sectors too. And then portfolio 2, instead of investing in individual companies in each sector, it invested in 10 Vanguard ETFs of those sectors. And then portfolio 3 finally is kind of going back to equally weighted indexes, the S&P 500, but with an equal weight. And then that green line kind of at the bottom is really just the S&P 500 total return. And so in summary, what we actually see is that portfolio 3, which is the S&P 500 equally weighted, outperforms, and then really in line with the S&P 500 and just under in this case, but actually if you model this out past the date to which it was modeled out, which is 2016, if you actually do this to 2018, even 2020, you actually see that this red portfolio, so portfolio 2, which is composed of those 10 Vanguard ETFs, starts to outperform also the S&P 500 total returns, that green line, mainly because, again, of these idiosyncratic risks. As we get towards 2020, we start seeing a lot more kind of movement there, and you see these sectors actually outperform more than anything else. And essentially the lowest, though, return was the individual stocks in that sector. And so showing that it's very difficult, even on value, long-term basis, kind of parameters and requirements that are similar to what Warren Buffett would essentially try to choose in a portfolio. You see that actually ends up being the lowest performing portfolio. And so that's quite an interesting, thing to see, is that you're trying to achieve, the average via an ETF, and at the end of the day, your goal though is to try to beat that average of, say, the S&P 500, and that you try to do that through individual stocks. But really, over a longer period of time, it's actually much more beneficial, especially for maybe even a 401k, Roth IRA, or any longer term portfolios that you may have in equities, to actually invest in sector ETFs. So again, because of this idea that they are more protected to the downside, and you have a higher chance of picking an outperforming sector than you do picking an individual stock that will outperform. And this can also be shown last year, essentially, with the value versus growth trade. Trying to pick individual winners in tech and then individual winners in value was really difficult. And if you just did a kind of inverse trade, on and off trade between the Qs and IWM, or the Russell 2000s, that strategy outperformed trying to pick any individual stock. So again, showing that picking above average achievers in each 10 sectors can be very difficult, and you're just better off investing in actual sector ETFs. And if you can pick these sectors, with a certain degree of confidence, which is much easier to do based off momentum. But if you can pick the right sectors, you can also outperform and beat the market. And so looking at ETFs and general indexes, there has been, a book written by Andrew Birkin called Shrinking Alpha, which actually goes into this and does a study over 10 years and then over 15 years. Again, 1990s being really the start of the index boom. Early 2000s, when we start getting these equally weighted ETFs, we start getting also new emerging market ETFs. That ability to diversify in sectors and not have to invest in individual stocks really grew in the early to mid 2000s, and then after 2008 really just took off to where it is today. And if we look at the last 10 years, 85% of large cap funds that are managed by professionals underperform the S&P 500. And over a 15-year period, that goes up to 92%, meaning over a 15-year time frame, only 8% of large cap funds which are professionally managed overperform or outperform the S&P 500. Only 8% of them. Again, showing that if you were to invest in indices and ETFs and certain sector ETFs over a long-term portfolio, you have a much better chance of beating not just the market, but actual professional money managers who are trying to find individual stocks that will outperform. And so that's really one of the great things about ETFs and why it can be such an attractive strategy, because being the average, especially within a sector, is not necessarily bad, and you may actually be able to benefit from that if you can pick those sectors. Stock picking in general clearly has a terrible record, and it's only getting worse the longer kind of time frame you look at. And so kind of to summarize all of these, ETFs are obviously a safe way to diversify your portfolio. It can make sense for passive income strategies, especially since you can still get dividend yields out of them. They're obviously also a great for use as a benchmark. I mean, if you're trying to look at what's happening with the financials, you can look at XLF, Energy, XLE. All of these types of ETFs can be really helpful in terms of a guidance of what's happening in the market, and also as a use as a benchmark. And then the last key part is that historically, they outperform some individual stock picking strategies by investing in different sector ETFs rather than trying to find individual stocks that will outperform. And so that's really the key there, and what makes them so attractive, especially for long-term kind of portfolios, and something you guys should definitely consider. So thank you guys for listening. Make sure to join Eagle Investors and check out the link in the description below. Thank you very much.